Okay, everyone, welcome to today's presentation. And today we're going to be looking at how we can structure a portfolio of dividend paying stocks and also how you can split up AUM and actually break down your own portfolio into the 6 different key sectors that are really important. So pay attention because you might just learn something. And I'm going to be talking about, as I say, how you can structure your own portfolio and how everything should be considered an asset, because everything I own is an asset and it's part of my net worth, and it means it can always be up for sale at any time, whether it's liquid or illiquid. And so let's jump into it, and I'm going to explain the different types of portfolio analysis and the things that we look at. So the first type is what we call active portfolio management. These positions are usually 1 to 3 months on average. These could be positions in the currency market, the bond market, equities, commodities, individual companies. Usually they have strong fundamentals, although it can also be a long and short portfolio. Usually you've got 10 to 20 positions, so you're building a well-rounded book. You would also hedge these positions and you trim them accordingly. So 1 to 3 months, and then you would review, and you would plan for that time frame to usually try and see some sort of gains and bring them into fruition. So that would be an active portfolio. The second one is what we call a long-term macro book. Usually these investments are 6 months plus. This is what we call a long-only portfolio, so you're not short selling, you're buying only on the prospect of a share or company rising in value. And this is obviously a structured portfolio rather than an open-ended one, and this would constitute what we call an investment. So this is more of an investment than, I suppose you could say, a speculative position. The third one is something called active trading or day trading, and this is essentially when you have long and short positions in the market. So for example, a lot of people will speculate on where a stock or an equity will go tomorrow or the day after, or they'll try and do what we call directional day trading, where they'll try and trade the trend, or they'll look at short-term catalysts and try to make money from individual moves such as non-farm payrolls, central bank monetary meetings, policy meetings, anything in an economic calendar. The majority of retail fall under this third one here, and most of them never make any money. It is possible to make money trading, and I trade equities a fair amount on the Dow and other positions, but the majority of people are attempting it wrong, and they're trying to trade on technicals and so on, and so it never really goes anywhere. And then we can see at the bottom, this is what we'll be looking at today: a dividend portfolio, the difference between yields and capital growth, cash on cash returns, the usual kind of thing. But before that, I want to just talk about the 6 sectors of any portfolio that everybody should have. The first sector is obviously a dividend paying stocks. Everybody should have cash flow. The second is what we call actively managed positions. So this is an active portfolio. The third is speculative positions. This comes under trading, long and short. The fourth is macro plays, which comes under long-term macro book. The fifth is real estate or property. And the sixth is tangible assets. This can be things like paintings, watches, number plates, anything that is not a property but is physical. But today we're going to focus on one portion only of that, which is the dividend side. And we'll look at asset allocations and what percentage you should hold, how to split up AUM and so on. So let's go ahead and progress. So how do we structure the various types of portfolios in a dividend paying portfolio? Well, what I've done here is I've taken a little screenshot of Coca-Cola, ticker KO. It's a blue chip company, it's a mature company. Even if you're not an investor or a trader, everybody knows Coca-Cola. And what we can actually see here is they're a US company, is the type of dividends that they're paying. So what you can actually see for 2020, for this year, Coke has split their dividends into 4 payments, so every quarter. So you can see for 2020 we had our first payment in March, at the start of March, We had the second payment in June. We had the third in September, and then we've just had the fourth payment. Okay, or we're about to have the fourth payment. Okay, so this is really important that you can see how they're structured. So Coca-Cola on paper will pay you 41 cents per share per quarter. So you get 4 payments a year. Now, obviously the structure of dividends can depend on the company. Some companies will pay you a dividend, believe it or not, every month. Some of them will pay you one dividend a year. Generally, the most common time of dividend is a quarterly dividend, so that's 4 payments throughout the year. And we can see here that Coke pay you 4 payments of 41 cents. So essentially what they're going to pay you is 41 cents times 4, so they'll pay you for the entire year. You can see their annual dividend is $1.64. Their quarter dividend is 41 cents, their annual is 1.64. So over the entire year, for every share that you own in Coke, you will receive $1.64 as a dividend payment, but it will just be split into 4 payments. Okay, so what we can actually derive from this and understand is that, first of all, Coke is paying its shareholders back some of the profits. Mature companies do this. But what's interesting is if we actually look at the share price of Coke, it's in the mid-50s, let's call it $50. If you bought Coke, for example, when it was trading at exactly 50, and you are getting paid 164 over 50, we can work out what that yield is. Okay, so if you're getting paid, 164, and you paid 50 for a share, 164 over 50 is the actual dividend yield. So roughly, it's around 3.1%. Okay, so what that means is that cash on cash, the yield at 50 is about 3.1%. Where people get confused is looking at the dividend yield and trying to understand why it's not anchored to a share price. Because if Coca-Cola, for heaven's sake, dropped to say $40 tomorrow, let's say it lost 20% for whatever reason and it fell from 50 to 40, if Coca-Cola continued to pay you 164, you're getting 164 over 40 as opposed to 164 over 50. The percentage yield obviously has jumped up significantly because you've paid less for the share, but you're getting the same amount of money back in your pocket at the end of the year, so to speak. So when you look at something like that, they then would be paying you around 4.1%, because 164 over 40 is about 4%, 164 over 50 is about 3.1%. So your cash on cash yield would have gone up a full percentage point. What's interesting though is if we scroll back a little bit towards 2016, we can actually see that Coke's dividend was as low as 35 cents a quarter. So what they were essentially paying you is $1.40 a year as opposed to 164. And we can see that on average, one of the things that we look for is yield growth in terms of the actual annual dividend and the dollar amount. So when Coke back in 2016, wherever Coke was trading at, you would be getting the equivalent. Now the yield itself, the percentage yield, could have been higher in 2016 if the share price would have been lower. So if the share price, for argument's sake, was $20 and they were paying you 35 a quarter or 140 a year, 140 over 20, the percentage yield is much higher. So people get too confused about anchoring the percentage yield to the actual share price, which is never a good thing to do. And that's why it's important, obviously, to have the importance of having cash flow from yields, but also you need some sort of capital appreciation. Because if you're buying Coke at 50 and the share price stays flat for the next 2 years, you're guaranteed to get your 164 over 50, which is about 3.1%, roughly. Coke's a little bit higher, but you get the idea. So when you see something like that, it's pretty obvious to actually understand and look at, that's your flat rate. Obviously you hope year on year dividends can go up. It's not always the case. They'll go up obviously as growth increases and so on, and profits rally and so forth. So it's pretty straightforward. The problem is that so many people look at the yield and they say, well, I'm receiving 6% or 7% in these high-flying names, especially in real estate investment trusts and those sort of areas that give high percentage yields. What they don't look at is potentially the losses. Now, Coke is a mature blue chip company. It's slightly different. What is interesting is the yield that they're paying you. So if Coke loses it, let's say over the next 12 months, Coke's shares drop 10%. On paper, if you don't sell your shares, if you bought in at 50 and the market's now trading at 45, it's down $5. On paper, your shares are now down 10%. The dividend that they're paying you is 3%, thereabouts. So on paper, it's bridged some of the losses. You're down 7%. If the share price stays flat at 45 for another 2 years, the next year the share price has obviously dropped 10%. Your yield is still at 164 because they halt the dividend probably because there's no growth in Coke. You're then receiving 3.5%, 4%. In year 2 and year 3, you've got 4%, another 4 is 8%, plus your 3% in that first year. You're getting 11% roughly in dividends, yet you're down 10% on your actual share. So the stock's dropped 10%. You've depreciated and lost 10% of your portfolio. You haven't sold it, so it's not a loss yet. The dividends have bridged some of the losses. So on paper, after those 3 years, all you've done is broken even. What you need to have is a share price that rallies, has an increasing dividend, and that can, when the share price does collapse, you still have that cash flow. And so many people buy into shares on dips. They buy stocks when they fall, and then they assume that their dividend is so high because they bought at that discount price. What you have to then do is take trailing averages. Usually I take a 12-month trailing average and look at it that way. Sometimes it's 18 months, sometimes it's 24 months. Now look at the share price. Historically, what the share's been trailing over 24 months, what the yield then actually is over those 2 years. Because there's no good buying on a dip and then saying you're getting a 5% yield when the person who bought 6 months earlier is still on that 3%. So the importance of cash flow here, and the takeaway is that there'll be portfolio splits. You have to balance appreciation versus losses. You hope that the dividends bridge some of the losses. And I own a fair amount of Coca-Cola shares in my dividend-paying portfolio, which is 20% of my entire net worth. And I've seen that when the share prices do go down, there's years where I'm making nothing on Coke. And it's very important to have a balanced share portfolio to actually aggregate, losses and so on. So this is very important, and I don't think people are perhaps talking about this so much. So when the yield changes every day, what sort of things can we look at? Well, defensive plays typically have higher yields. High-flying names, tech stocks have lower yields because essentially it's baked into their appreciation. So you're more likely to get growth there potentially, and so on. And of course the balance between capital appreciation, so stock appreciation, and dividends. Bridging those losses is very important. How can we set up a portfolio as a percentage of the total holdings or your total net worth? This is very important. And how can we then price in a dividend yield growth? So Coke, the example that we gave, we can see over the last 4 years the dividend growth that we've had, but it's been in line with share appreciation. Okay, so that's really important. And our dividends built into future prices, and do not become purely income orientated. I've seen so many investors have different investment goals and plans. Some are purely income orientated and they are content with this strategy. Obviously they're not maximizing their cash, their income, their capital gains. So you have to keep that in mind. And some are looking at purely total returns, which obviously brings us into the different types of portfolios that we could be looking at. Okay, so that's really important. So, for example, pure growth has worked for the last 10 years. When we look at a correction, if you took your profits, good for you. You've got some money. Otherwise, Mr. Market is actively taking away your gains. So keep that in mind. For myself, I'm a cash flow investor, but I also seek capital appreciation. I also speculate, and I also have a shorter term book and an active book, which is 10 or 20 positions in a hedge. And this is the most important takeaway. So if people are building their safety part of their portfolio back in 2009, 2010, this is when the market bottomed in March 09. If you look at investment grade blue chip stocks, people that bought them on sale have seen a lot of capital appreciation, but they've also seen growing dividends. So this part of portfolios is dividend growth orientated, but it's also what we call total growth orientated, which is capital appreciation, which is just as important. And to have a well-rounded trading account and portfolio, you need to be hedged across these 6 sectors. So those are dividend-paying stocks, actively managed positions and active portfolio, speculative positions, macro plays, real estate and property if you want to do that, and tangible assets, paintings, watches, and so on and so forth. So I hope this helps everybody, and this is just a quick video on how to structure a portfolio and some of the things you should be looking for. Thank you.